Regardless of how you invest in the private markets, right, you are taking a level of risk that doesn't quite exist in the public markets. Public market companies are very well established, right? Tons of reporting, tons of controls in place. The odds of them going under are far lower. As I mentioned earlier, there are a lot of secondary markets that are being built right now. What does that mean? Quite literally, like the stock market, you're going to be able to get into and out of private market positions like a traditional stock, which is really exciting and has never been done before.
Welcome, everyone, to a special Directed IRA webinar episode. This is Mat Sorensen. Excited to be with you today because we are talking about an alternative asset investment class that I think is critical. Every investor needs to know. A lot of people know about real estate. They've maybe heard about hedge funds or private equity, but venture capital has been a very successful asset class. It's one that comes with its own risks and rewards, and we want to make sure you understand those as you're investing in that asset class. But I am not an expert on that as much as I would love to be, pretend to be. I have invested in it, and maybe we'll talk about that a little bit today, actually with my IRA. But I've got Chris Lustrino here from KingCrowd. Chris's company is really into the analytics and seeing how venture investing is performing, different funds and assets are performing. He has a venture fund himself, but I'll let Chris tell you more about him and what they do. But welcome, Chris, to the webinar today, and thanks for being on.
Hey, thanks so much for having me. Glad to be here.
Yeah, Chris came highly recommended from Mark Peck on our team to talk about venture investing, because I asked my team, I'm like, can you give me someone that's not going to talk about real estate? I mean, we do love real estate here, but I'm like, we need an expert on like venture. Let's get something cool and exciting. We do have a lot of accounts here that invest in venture. And so let's just dive into it, Chris. Why don't you explain what venture investing is? Maybe distinguish it from other investing, even like private equity. I think a lot of people mix those up.
Yeah, you're absolutely right. They are two very distinct, unique types of investment opportunities. So venture capital, right? Really, this is kind of what I'd call your most risky portion of all the asset classes that may exist out there. This is when you're backing, early and growth stage companies, when they're still burning money, when they're maybe still just an idea on a piece of paper, and essentially you're trying to help those businesses get going, right? But the upside or excitement around what that type of opportunity is, one of the best examples is, if you invest in Uber, which one of my advisors did, if you had put $1,000 into Uber, or no, $100 in Uber in its first round of funding at a $3 million valuation, when it IPO'd, it would have been well worth north of $1 million. So the upside in venture investing is extremely high. It also comes with an incredible amount of risk. So that is venture capital. It's the risky, high upside investment asset class.
Yeah, at our last Alt Asset Summit, we had Lisa speak. I forget her last name, but she's president of Tech Coast Angels, which does angel and venture investing. And I remember one of the things that she said, if you invest in one company and one kind of startup venture company, your most likely outcome is you will lose everything. That's your most likely outcome. Who's excited here to invest in venture, And but if you look at investing in 10, because you could get one that maybe gets 100x type return, you're playing the numbers there, so to speak. And like you mentioned, Uber would be like the super well-known example. But what are the numbers? Is it really like that? I mean, is it these are companies that have burn rates, you invest in them, and in the slide deck, and I just seen these here, we see people investing in them here. I've done some myself. The slide deck is like, here's how we're going to burn your money. This is our burn rate until we can actually call ourselves a company and profitable. But what is the risks of it? Maybe dive into that here for a second, if you don't mind.
Yeah, I mean, you're exactly right. And one of the challenges with traditional venture investing, and one of the things we'll hit on today, is that the traditional venture model might be a bit broken from my perspective. And I think there's ways of improving on it. Historically, right, venture capital has relied on kind of, hey, we're going to have one that really hits in a major way that returns the entire fund plus some, and then the rest are going to do okay, and several of them are going to fail, right? And that's kind of the historical model. And the reason being is when you're trying to reinvent whole new markets, right? So Airbnb trying to kind of reinvent the way that hotels are right, or the way people vacation and travel. Like that's a really risky category. And the odds that it's both the right timing, the right product, the right team, the right execution, and you pull it all off and you have the right capital stack to succeed is very, very unlikely. So you're taking
Yeah.
on an incredible amount of risk. And there are other strategies that you can take within kind of venture style investing. To me, what's really exciting about the entirety of the private market ecosystem is that you have small businesses, you have medium businesses, you have large businesses, and just like small cap, mid cap, large cap, each one of those comes with its own risk and return profiles. And I think taking a blended strategy can really help you manage and mitigate some of that risk that you might be taking by shooting for the unicorn on occasion.
Yeah. It's crazy though, because a lot of those companies that do succeed, I mean, I just look like the apps on my phone. I mean, how many of the apps on my phone had a venture capital investor that helped get it off the ground, right? Isn't it
Totally.
crazy? Like, it's just even like I just think our merchant provider like Stripe, has been a really successful. I know a lot of venture funds are invested in. Everybody's used Uber. I mean, these are not just like small companies. These are companies that really can go big. But for every one of those, there's another dozen that have crashed and burned.
A
Right.
dozen, 100,
Yeah,
10,000.
maybe more.
Well,
Yeah.
and one of the great examples I try and use, right, is Y Combinator is one of the most well-known accelerators in the United States,
Hmm.
probably the world, right? And I'll ask people, okay, tell me the biggest names from Y Combinator, and they'll say Airbnb, they'll say Dropbox. There's a few names. I go, okay, what else? And they kind of stop there. And I go, do you know every 6 months they're backing 300 plus companies? So they're probably backing almost 1,000 companies a year. And you've named me 3 or 4 names over the past 10 or 15 years. And that
Yeah.
just tells you how many of them are going under.
Wow, that's crazy. Well, let's get into your presentation. Chris has a lot of insights on this, and so I'm just going to turn over to you for a moment here, Chris. I might interject with questions,
Please.
and then if you guys do have questions, throw them into the Q&A. We'll grab them after Chris is done here. But I'm going to let Chris kind of run and just be professor here for a moment, and
Yeah, I'd
then
be happy to do that.
we'll come back and do a little Q&A and a little more
So
conversation.
for those who don't know me, I'm the founder and CEO of a company called KingCrowd. We've been around for about 6.5 years, and really started this business with the idea of building a Morningstar Bloomberg-like solution for what we define as online private market investing. So there's been this really exciting trend over, frankly, the last almost 10, 15 years now, where private market assets that have traditionally lived offline, right, and been transacted by the venture capital and private equity shops and big institutional funds are becoming available to the masses, where you, me, and everyone else can invest $100, $500, $5,000 into individual deals and fund products across all of these alternative asset classes that have historically existed, again, only for the mega institutions and the ultra high net worth individual. And that's everything from your, startups and private equity to your high end artwork like your Van Goghs to your commercial real estate, multifamily home, single family home, Airbnb rentals, your credit, right? Whether that's commercial credit, whether that's consumer loans, so on and so forth. Quite literally, each and every one of these investment asset classes, UI and everyone else can now go to these marketplaces that look and feel like a NASDAQ or a New York Stock Exchange and quite literally transact into a multitude of unique individual assets within these different alternative asset classes. Now, today we're going to be focusing in on kind of the venture capital and private equity space because that's really KingCrowd's bread and butter for the last 6.5 years. But just in the past year, over $30 billion from 2 to 3 million unique individuals have invested into private equity and venture capital style investments online across over 3,000 plus individual unique investment opportunities. All of that is to say is the question people ask is there really deal flow out there for me to be able to access and invest like a venture capitalist, like a private equity shop and get good deal flow? And the very, very simple answer is yeah. We're talking about thousands of unique individual opportunities for you as an investor to be able to go find, identify, and invest into these opportunities with really small check sizes. So when we talk about the incredibly, high failure rate traditionally of private companies, especially early day companies, building a diversified portfolio. And some people argue for 25, 50 to 100 unique individual companies in your portfolio. You need to see a lot of deal flow in order to build a portfolio that's constructed really well. So yes, there's an incredible amount of opportunity that's emerging in this market. There's over 100 unique investment platforms where you could go and find all of these unique individual investment opportunities. So you as an investor have an incredible amount of deal flow at your fingertips from your home. You no longer have to be a part of an angel group. You no longer have to be able to invest in a venture fund, which you likely can't do anyway. You can now do this literally from your home computer, which is pretty awesome, or your mobile phone. So just to get into kind of a few key things that have been evolving in a major, major way over the past decade in venture capital and private equity. So historically, the access to deal flow in this ecosystem is next to zero, right? Unless you went to Stanford or got an MBA and your buddies with a venture capitalist already, the odds of you being able to access deal flow in kind of the startup venture ecosystem is pretty much next to none. Frankly, the access to good due diligence in the venture capital markets historically has been quite poor. I actually came from that world. I worked for a firm that did private equity diligence. That was our bread and butter. And it was amazing how poor the diligence was because of a lack of good data in the private markets, right? Traditionally, private companies don't have to share any data about their business. So literally, there are companies like FTX raising hundreds of millions of dollars with fake financials or not handing financials over at all. The amount of things that have gone wrong in the venture ecosystem because of the lack of sharing of data has been tremendous, especially over the past 10 or 15 years. Using real data is very, very important for making smart investment decisions in this market. And I believe there's a path forward for that. If you look at traditional VCs, fees can be really high, right? Investment minimums, typically, if you're an angel, you're talking about 50 to 100K for one deal. If you're going into a fund, it could be $1 million plus to get into a fund. And frankly, there's only one investment thesis that's really been undertaken by the venture ecosystem for the past 15 years, which is shoot for the unicorn, right? Go for the big idea over good execution. And at the end of the day, there's next to no liquidity in these traditional private markets, meaning you're holding these assets for at least 8 to 12 years while they progress as a business. So we move to today, right, where there's thousands of deals available at your fingertips to be able to invest in on any given day. Every one of these companies that's raising money and offering equity or debt in their company is required to file CPA created financials. KingCrowd is sitting on financials, income statements, balance sheets, cash flow statements for 9,000 plus private companies, which creates the opportunity to have data science and data-driven solutions that frankly eventually can be powered by AI solutions to invest into the private markets in a far more intelligent way that could drive outsized returns. There's almost no fees for investors in this market. There's extremely low minimum investments, $100, $500, $1,000, which enables you to build highly diversified portfolios with not a lot of capital. You could build your own investment thesis. We see many people undertake many different investment theses and how they're investing, whether they're investing in small business loans or medium-sized businesses that can grow from 10 to $20 million and they could double their money, but it's a far less risky bet than a traditional venture investment. And then they could have their part of the portfolio that's a venture investment as well. And lastly, what we're seeing in this market is the rise of liquidity solutions. Over the next 5 years, I feel pretty strongly that we're going to start seeing real fluidity in these markets where you could quite literally buy into an asset and after holding it for 1 year, pretty much be able to sell that at your own asking price, which is really, really exciting. So one of those things I hit on, right, is that venture capital is one very specific thesis. And there's a lot of information here, but to boil it all down, venture capitalists are looking for mega businesses, right? Your Ubers, your Airbnbs, your OpenAIs that could drive 100 to 1,000x plus returns from investing in them. But the reality is there's very, very, very few of those opportunities that are going to be built in the next 5 to 10 years. The majority of businesses are going to fall into your small to medium business and your large business category. What's nice about this new world of capital raising and investing is that we're seeing companies across the entire spectrum that have historically been underserved that are now raising money in this market. Companies that are doing $4 to $8 million in revenue that have a clear path to grow to 20 to 30 million in revenue and 4 or 5x your investment opportunity and do it at a far less risky bet, right, than going into the traditional venture investments where it's 0 or 1,000, right? There's micro businesses, there's small, coffee shops and things like that that are raising at 8 to 15% interest rate loans to open up location number 2 or location number 3 or buy equipment to, upsize their revenues that are returning at a really high rate of success. So you can create your own strategy and navigate these waters in a way that's never been done before because of the access to deal flow across the entire spectrum of types of businesses and investment opportunities.
Let me jump back to that slide if you don't mind, Chris,
Please.
just because I want to hit a couple of things. This is really good. Because I think a lot of people get confused between private equity and venture. And I think this is where you've got those large businesses and those smaller businesses. I think those are more of a private equity play typically, right? I mean, that is, and those types of multiples that you see, it's more of this is an existing business. Yeah, it needs capital to grow, perhaps, or maybe there's a buyout and it could be growth equity. There's lots of strategies there, but those are more of your larger or smaller businesses. They're not going to get a 1000x return, but they're also not going to go to zero either. I mean, it's possible they could over leverage, but tell me, maybe explain a little difference between private equity and venture capital to everybody.
Yeah, yeah, great question. So, private equity, venture capitalists are looking for big ideas, right? They want the grand scheme of thing that's going to reinvent the world. Private equity investors are looking for a return. And because of that, they're looking for good, they're fairly good to very good underlying fundamentals of the business, right? What a private equity investor is looking for is you have real revenues, real traction, are profitable because oftentimes the way a private equity investor is investing is they're buying equity into the business and then they're using a lot of debt to buy a portion of the equity. So ultimately, by utilizing debt, they have to be able to pay that debt off, right? And the way they pay that debt off is with the profits that the business throws off. So they're looking for profitable, high growth businesses that need growth capital to take them to the next level. So they're very much looking at those fundamentally sound businesses. Oh, you're doing 69 million in revenue. You think you could grow to 30 or 40 million in the next 5 years with the right growth capital and the right executive team? Great. We'll come in, we'll take a majority ownership position, and we'll help grow this business to be able to 4 or 5x our money in the next 3 to 5 years. So that's kind of where their mindset is. So they're not looking for the company that changes the world. A lot of times they're looking at things like industrial companies you've never heard of or
Yeah.
consumer cyclical goods, right? That you don't even think about. They're looking for more of those just established businesses that they know year after year are going to throw off cash. And with a little bit of productivity and optimization and those types of things, they can grow a bit and be able to return nicely in a fairly short period of time. Very different style of investing, very much fundamentally driven, feels a lot more like the public equity markets, which is exciting as an individual investor to be able to access those types of investments in the private markets.
Okay. They also got a much longer time frame on venture.
Way longer time frame. So as I meant, they'll say 8 to 12 years, right, for an exit in venture. I think what we've been seeing over the past 10 to 15 years is closer to 10 to 15 years for an exit. So the timelines to exit are just extremely long in venture capital these days versus you look at some of these small to large businesses and you're talking about anywhere between like 3 to 7 years on the high end. So very different, you're talking about half the time to exit. So if you could have fewer failures, more wins in a faster period of time, your internal rate of return, you could actually do very, very well, even if you're not hitting on that 1000x. And what I tell people is to build a blended portfolio, right? You want your venture investments. Maybe that's 20% of your portfolio, and the other 80% is going into a mix of these small, medium, large businesses, and maybe even some of the kind of debt loans or rev share loans of a real micro business.
Awesome. Okay, let me come back on access to capital that you had that a little bit earlier, or kind of
Sure.
access to deals. Because I think, a lot of investing in alternative assets, and this is one we try to teach a lot, is it is really kind of who you know. Now there is this crowdfunding type ecosystem that's taken over for venture and startup investing in particular. But I do still see it. A lot of it is still even kind of word of mouth. And I know someone that's good at understanding those investments, or someone else has invested in it, or they're on one of the sites that you mentioned on there, and they're investing in that deal because Sequoia invested in that deal. And it's like this, like, product credibility, because I think, it's very hard to determine those winners and losers on these websites. But I still think, try to explain, like, what's the human connection still to this? Like, if, like, I mean, how do I make a good investment decision if I'm on one of those sites?
Yeah,
How
it's
do
a
I
great
get more
question.
data? And maybe it's data information. What is it? How do I know?
Yep, it's a great question, and this is not like a, you know, calling out KingCrowd and wanting to come use KingCrowd, but what we do at KingCrowd, right, is what's so exciting about this market is the fact that you have access to all the financials, all the terms, you know exactly what's going on with the business, right? So we collect over 300 data points on every business that's out there. So we have that on 9,000 plus companies, literally on a daily basis. As new deals go live, we collect the data on it. We have a quantitative rating system that rates all of these companies on key fundamentals like valuation, rev multiple, founders experience, terms of the deal, financial performance, burn rate, you know, debt to asset ratio. We're looking at all of those things. And one of the things that I've told people, yes, you need that human connection. There's no doubt, but this is a numbers game. So if you play enough of the deals, you're probably going to win. So you need to build a diversified portfolio. And if you can use data and actually remove some of those biases, I actually think your portfolio can perform better than, you know, getting sucked into that one deal because you love the founder. And the example I use is, you know, when Mark Zuckerberg came about, right? People didn't think they didn't like him as a person. They're like, oh, that guy's a jerk. And then venture investors were looking for all these guys like him. And I remember one of the guys I worked for at a venture backed company raised $16 million on basically them thinking he was like Mark Zuckerberg. You know what? That company basically sold out for nothing and never generated any revenue. And that's more likely the story than not. So this cult of personality, I actually think has been really dangerous and not good for the venture ecosystem. And what I would argue for is actually more of a data-driven approach. Sometimes I get psyched about a deal. So if you go to Republic or WeFunder or Start Engine or Net Capital, wherever
Mhm.
you go and you check out these deals, you could get sucked into the pitch video and the offering page and go, oh my God, there's a huge story here. And maybe they're marketing on Facebook and they retarget you and you get psyched about it. And then I go look at the KingCrowd score and it's like they burned $11 million last year. They're raising it at 22 times revenue multiple. Okay, I might have almost just been suckered into a deal that's really not that good. So looking at the underlying fundamentals and the real data, I think is so, so important. You have to do your diligence and try and remove as much emotion from it as possible to be intelligent about your decision making. Now, once you've done that, right, you still should get to know the founder. And the beauty of this space is that you can follow these companies. If you're on WeFunder, Republic, any of them, you could quite literally follow the company. And now you could go and watch their pitch video. When they say we're going to have a webinar, you could attend that webinar. You could ask them questions. Frankly, you could reach out on LinkedIn or send them an email. If you're really interested in writing a bigger check, you know, even 5 or 10K, say, hey, I want to chat with you before I invest. And just how they react to that, right? Do they respond? Do they want to talk to you? Should tell you a lot about that founder if you want to kind of know the
Mhm.
fundamentals of the individual. So there's still an opportunity to get to know the individual, but I also think removing emotion from this process and trying to be more data driven is very, very important for investors to get good returns over the long term.
All right, love it. I mean, I knew you're trying to solve for this a lot in King's Crowd and this, decision making, because, I think there's some types of companies that are at the stage where it's like you can actually see their product or you could actually be a customer. But a lot of these you can't even be a customer yet. They're like, or there's different stages of this. And so I always like where you can be, it's like go test the product, go be a customer first. You might love the idea, but like maybe go test the product yourself to see. I think that can give you a good idea too. How often is it where you can actually test the product before investing though? Maybe you have a better idea on that.
Yeah, it's a good question. So, you know, I would say about 30% of companies are pre-revenue. So, you know, pretty much say that 30% is your non-touchable, non-interactive opportunity.
Mm-hmm.
Everything else, to some degree, is out in market. Now, if it's an industrial company, you're probably not going to go and interact with that, right?
Yeah.
Couple of key things you should always be thinking about is, do I understand what it is they're doing? Do I understand the problem they're trying to solve? And does it make sense how they're solving it, right? I might not be a scientist, but if I can look at an industrial product and say, okay, I could see how that improves on that inefficiency. All right, I understand it enough to feel like I can invest, right? If you truly don't understand it, it's probably something you shouldn't be investing in. unless you're taking a truly passive approach and building a very big portfolio. And you're okay having those companies in there where you're like, I don't really know, but I'm writing such a small check. I'm not overly worried.
Love it.
So one of the things that I like to hit on, right? People want to understand, well, what does some of the companies in this market look like? And there was hundreds of examples I could have put on this page. So I just kind of quickly pulled some top level names that I wanted to share with you. Again, to give you a sense of what I think is really exciting about this market is with 3,000 plus companies raising in this space now in any given year where you can invest in every one of those deals, it's pretty much a solid index of venture, private equity, and your small, medium, large mega businesses. Like you can get exposure to that entire spectrum of types of companies. To just give you a sense of some of the companies we've seen out there, right? So, well, have there been companies that have raised an equity crowdfunding round and gone on to raise a major upsize round from venture? Customer.io is a company that raised a huge round from Spectrum Equity after raising a whole bunch of money on Republic, and they've grown to like 30 or $40 million in revenue. That was like a year ago. They might be at like 70 or $80 million now. But big private equity shop coming in and writing a massive check, right? And that was a company where you could have gotten in far before the private equity investors came in. Um, Andreessen Horowitz, NEA, all the big names in venture, right? Do any of the companies that raise from the big shops, do they come and raise money in this space? Yeah, they do. There's been a bunch of them actually. Just to give you a couple examples, Mercury Bank, they raised $120 million from the likes of A16Z and NEA, and there was a whole bunch of big guys in there. And then they went and raised $5 million quite literally just after announcing their Series B on WeFunder on the exact same terms. And they sold that out in like minutes. They actually had $17 million in indicated interest. They just couldn't accept it all because the limit was $5 million. But it was an opportunity for them to really ingrain their customers with them, right? Hey, are you using our banking product? Well, now be an investor in our product as well. Substack, right? One of the biggest kind of blogging platforms out there, raised 15.3 million from A16Z, raised another 5 million, same terms on WeFunder from their own writers and people who make Substack what it is. So there's two mega VC backed companies. And again, there's probably several hundred that I could mention here. Have there been companies that have grown substantially by raising money in this market? Just to give you a couple examples, Liquid Piston is a industrial company that's doing a lot of defense work, kind of engine technology, energy technology. They raised $50 million across 6 rounds of equity crowdfunding and grew from an idea and a piece of paper, right? A science project to over $8 million in annual revenue coming from the government and growing really quickly. BabyQuip is a really interesting company. The Airbnb for baby rental equipment, right? If you're traveling and you need a crib or toys for your kid, you could get it from a local host. They again pretty much grew from $400,000, right, just getting off the ground to over $5 million in annual revenue, and have raised $5 million across 3 rounds of funding, with institutional funding interspersed within there as well. And then, have there been any exits? There's been actually probably upwards of 100 exits, even though this market's still very, very young. But just to call out a couple, there was this Generation Genius company. They raised on Start Engine a $9 million valuation, and they've done share buybacks anywhere between 4 to 10x for investors. Getting a 10x is exceptional, right? And then Mevo, they raised on WeFunder at a $12 million valuation, sold literally 9 months later to Logitech for a $50.2 million cash offer, which is basically a 5x on your money in 9 months. Investors were very, very happy. So I show you all of these to give you a sense that there is a spectrum of successes and types of companies raising this space that, again, are very representative of the wide breadth of types of companies that are raising in this market that you have an opportunity to be able to invest in.
Yeah, and I think that's the critical part there is those examples you all gave are ones that you could have invested in. You didn't have to get, Andreessen Horowitz. You didn't need to know, the super exclusive VC firm to get in on it or be in the tech scene or the venture scene. You just need to be on WeFunder at the right time on some of those or whatever the platform that they went to.
100%. And so we ended up, we believe in kind of taking that index approach in this market and taking a fully data-driven approach to venture investing and private market investing. So we developed a fund called KingCrowd Capital. It's hosted on AngelList. That's our fund admin. and we're investing in 100 companies utilizing our rating algorithm to identify those companies. We've invested in about 35 companies over the past 18 months. And just within that first 18 months, about 16 of those 35, 36 companies grew at least 30% within the last 18 months. So just to give you a few examples of companies we got in, the valuations we got in at, and some of the growth rates we saw, right? Yellow Pay went from 230K to 3.5 million in revenue. Shift Post went from 4.7 million to 8.4 million in revenue. Consumer Direct, a company that I think is probably going to be getting ready to IPO soon, went from 70 million to 84 million dollars in revenue. And you could see some of the revenue CAGRs here. All companies doing extremely well. And again, over half of our portfolio grew at least 30%. I think over 70% grew at least 15 or 20%. And 5 or 6 of the companies' revenue growth didn't apply because they're med tech or biotech companies that are still in the early stage development process. So our data-driven approach, I don't show you this to show off, anything. It's to say, taking a data-driven, disciplined approach to venture investing and private market investing can drive really solid and exciting returns. And yes, you can find great opportunities in this market by taking that data-driven index-like approach to venture investing, which I believe will very much be the future of venture and private market investing.
Are the institutional VC funds doing this? I mean, aren't they doing this behind closed? There's the next seed round, the next round that's coming, and they're analyzing these numbers and doing this. Yeah.
So a lot of companies, I would say almost 40% of companies that come to this market are already venture backed. And their venture investors are saying, do it. It's been proven to increase lifetime value of customers. It's been proven to be a solid way of raising capital. So they like it. They're like, okay, there's another part of the capital stack. Like, this isn't a bad thing. This is an additional thing you can do to continue to raise the capital you need to grow your business. So it's very much accepted amongst the venture community at this point, other than some of the real old guard. Most people are very much into adopting this space. We even see on some of the platforms, they will be the lead. The fund will be the lead investor, and then everyone will come in behind them on the platform, which I think is really, really cool. The last thing I'll say is there is even a private equity firm that is actually looking to bring their deals and syndicate $1 to $2 million of an $8 to $10 million equity round for their private equity deals. That's fully institutional round. And they're like, hey, we could build a community of investors that love what we do. And this could be a new part of our capital stack. So we're seeing it all. And that's what I love about this space is you can get exposure to so many different types of investment opportunities.
Awesome. All right. I see we have some questions that have flown in. What do we got? Do we have questions, Johnny, I see somebody had their hand up, but we'll just hit your Q&A here. Grab the mic if you got it. All right, let me ask you guys, see if you have any questions in there. I saw someone's hand up. I don't want to call them out. Throw your question into the Q&A. Chris, tell me about a typical fund. So I mean, you have your own fund here, and is the screen good? You want to clear? Oh, there we go. Okay. All right. So we got the share off. There you go. What should you expect in a fund? Like, rather than me investing in one company at a time, to talk about the differences in a fund strategy and investing in a fund.
Yeah, regardless of how you invest in the private markets, right? You are taking a level of risk that doesn't quite exist in the public markets. Public market companies are very well established, right? Tons of reporting, tons of controls in place. The odds of them going under are far lower, especially in any given moment of time, than in the private markets. So you are taking risk when you invest in these private companies. So with that, right, it comes back to you need to build a diversified portfolio. At least that's a strategy most people would tell you to undertake. With that in mind, it takes a lot of time, right? You should probably be spending anywhere between, it depends on your check size, right? If you're writing $100 check size, you don't need to spend 10 hours diligencing the deal, but you should be spending a couple hours to probably 10 hours diligencing any deal that you're investing, $1,000 to $10,000 in, right? And so if you're trying to invest in 10, 15 companies a year in order to build that diversified portfolio, it's a lot of time. And then, the question becomes, Do I have some sort of, selection bias, or am I not putting enough time in, or am I missing the deals because I'm busy and then I come in every couple of months to look at the deals and that's preventing me from optimizing my portfolio strategy. So there are just limitations as an individual, right, to making sure you optimize your portfolio. That there's a reason why I have my, small Robinhood account that I play around with, and then I just have a financial advisor invest most of our money into
Mhm.
ETFs and index like products, right? So I don't have to worry about it. And that's kind of the strategy that I often, would say undertake in this market as well is, hey, you can build your portfolio, have fun, take your bets, take your picks, and build a portfolio of 15, 25 companies. But if you just want to have exposure to this market and know that part of your portfolio is working in the private markets where you might see outsized returns, utilizing a fund product, I think makes a lot of sense because it's just set it and forget it. You put the money in, and now you have a professional kind of money manager managing that money and taking care of it for you and building that portfolio for you. And that's their full-time job, right? And that is part of what we do at KingCrowd. So we offer that opportunity to have that index like fund that we've been building for almost 2 years now, and we'll continue to build for the next 2 years, just for our first fund, right? And we'll have future funds as well.
So on some of the sites you showed earlier, like Republic, WeFunder, Angel List, typically I'm investing in one company, right? And I typically doing smaller dollar amounts, right? But if I'm like, I want exposure to venture and I can get in a fund and they might be invested in 10 companies, 12 companies in the fund, right? And that kind of cuts my homework a little bit. I mean, I got to look at the
You bet.
fund.
Yep.
So I think there's a lot of convenience to it. A lot of investors like, and that's what institutions do, right? I mean, that's why they're going to, a VC fund to be like, well, we don't know. We're not in the business of this. We're not going to diligence this stuff. you know, we just want to get a good return on our money. So, but of course, now what are the typical fees someone would see in a venture fund? The fund's got to make money. They got to pay the bills there. It's a profit center for them. What's the typical fund structure you see in VC?
Yep. Typical fund structure of a venture capitalist is going to be what we call 2 and 20 is the traditional model. What does that mean? Typically, they'll be investing out of that fund for anywhere between 2 to 4 years. And in each given year that they're investing out of that fund, they're going to be charging that management fee of 2%. So if they raise $100 million, just to make it simple, they will literally be taking down $2 million a year as a management fee to, take care of their staff that goes and does all of the diligence, all the deal sourcing, so on and so forth. And then what does that 20% number mean? So at the end of the fund, maybe they raise $100 million. Let's say they do exceptionally well and they return $500 million. So they just made you 400 million on top of the 100 million in principal, right? From that 400 million, they're actually going to take 20% of those gains. So from that 400 million, they would take what, about $80 million in profit at the end. And what they'll tell you, and they're not necessarily wrong for doing this, that's aligning their interests with you. They're saying, hey, we take a fairly small fee on the front, but on the back end, if we perform well, we can do exceptionally well. So it hinders your performance a little bit because they are taking such a big cut at the end, but it also really drives them to try and perform well with the fund. Now, our model is to cut those fees in half because we believe by having automated deal sourcing and data-driven decision making, we can make this far more efficient. And that's what we've been working to do. So our model is 1 in 10. And we hope in the future there can actually be even more fee compression in the space because we think that's really good for long-term returns for investors.
Awesome. All right. Now, of course, your IRA can invest in a venture deal, right? We've had many IRAs invest in funds or in specific deals, even on Republic or Angel List or WeFunder. And so I know some people that hit me up and are like, "Hey, I've been doing this with my IRA." One of the things that's nice about it for an IRA is, particularly when you're investing in a company, these are almost always C corporations. So we're not running into UBTI or UBIT issues. It is nice too. You get the audited financials, not that you have to be an expert or a CPA to read them, but you do get some some important data points from that about the company. But I think they're actually pretty clean investment for your IRA. And a lot of people who are looking to use their IRA or 401k dollars, this is your long-term money anyways. And these, I'm in my 40s, and a lot of our average age of our client is 49, and so they have an investment horizon where they can't even touch it until they're 59 and a half, even if they wanted to, you know? And so I think for your long-term money, it can actually be a great place to go. Of course, you want to make sure you're diversified, not betting it all on just one company. Maybe you do hit it with Uber, but maybe you crash and burn because you did it on Ask Jeeves, you know, for any of you old enough to remember that one. So, all right, Johnny's got a question over here.
All right, so we have, what is the typical exit timing for investors in the fund itself?
Yep, great question. So typical fund that we're seeing today in kind of the venture ecosystem is somewhere between 8 to 12 plus years. You might start seeing returns in year 8, right? Companies start exiting, returning funds, but the full kind of seeing it through is probably closer to 10 to 12 years. Now, I think a lot of that is going to change in the next decade. As I mentioned earlier, there are a lot of secondary markets that are being built right now. What does that mean? Quite literally, like the stock market, you're going to be able to get into and out of private market positions like a traditional stock, which is really exciting and has never been done before. So it's still very, very early days, but we're seeing real volume there. And I think when this thing gets to some level of scale in the next 3 to 5 years, it will become very mainstream for people to be able to exit these things within 12 to 18 months if you decide to do that.
What about some of the funds you seeing? I know, I think who was it? Was it Sequoia or someone still has like an evergreen fund?
Yeah, great
Um,
question. There are some different styles of funds. So evergreen funds are, it's not, there's something called a closed end fund, which is, we invest the money, and that's kind of what our venture fund is today. We invest the money and then we return the money, right? If we
mm,
raise 10 million, raise the 10 million, we deploy the 10 million, and then we try and return it all plus the return, we give it all back and it's done. That fund is over with. Then you start another fund. An evergreen fund is actually where you invest the money as it comes back. You continue to just reinvest the money unless someone is asking for their money back, and they could take their money out, at certain periods of time. They could take their money out and new people can come in. But it's all one kind of existing fund that just continuously reinvests and grows its net asset value over time. So that's an evergreen fund. There's intervals and periods where you can cash out, but it's not like you can't do that every day. It's going to be certain periods of time, probably every 2 to 3 years.
all right, let me ask about accredited investor type issues. I know some of the crowdfunding platforms in particular, there's the Reg CF and they can get around the accredited investor. How how much investing goes on? Or let me ask it another way. If I talk to me if I'm an accredited investor, what my options are versus not accredited investor.
Great question. That's probably one of the most exciting things about our industry is pretty much everyone can partake in almost everything. So like I mentioned at the beginning, when I said there's 3 to 5,000 unique individual investment opportunities out there, pretty much all of them are available to all of you, regardless of accredited, non-accredited. Reg CF, Reg A Plus is proliferating, and we're seeing thousands and thousands of companies leverage it. So the reality is everything we talked about here today, pretty much all of you, regardless of your accreditation, will be able to partake. Now, if you are accredited, there's even more opportunities available to you. Angel lists, SPVs into individual deals. You'll be able to go on there and check out their deals. And they do easily hundreds, if not 1,000 plus deals a year. So that does add another portion of deals that you can do. And there's a few other accredited only platforms, but the bulk of deals have at least some exposure for non-accrediteds to get involved now, which is really, really cool.
Yeah, and for Reg CF, right, that's going to depend on how much you can invest, depends on your income. Reg A, I believe, is the same income net worth on how much you can invest. So there are some rules to that, but it does and I've seen Reg A has really taken off. It took a little bit a while, and I think Reg CF is they've increased it to 5 million, right? They can raise up to
Yep.
5 million on Reg CF now. So I think that used to be like 1 million, and I just don't think it was enough. So, okay, well, what's next, do you think, for venture? I mean, I know you've got your guys' angle on it, getting this data and getting information. It's quite interesting, actually, what you mentioned earlier about, they have audited financials, and you guys are grabbing those and starting to do some analysis on it and track it and see how people are doing. But what do you think is next for venture that investors should be looking for?
Yeah, what I would say is extremely exciting for the entire venture ecosystem. that a lot of people are starting to talk about. And I do think we sit in a very nice position in the market for this is, um, you know, we're seeing AI proliferate and disrupt all of these industries. And I think it's going to play a fairly significant role here. When I talk about saying, there's going to be fee compression, one of the reasons for that is we actually do think this is going to become far more of a data-driven decision process than it is a human process that exists today in the venture ecosystem. And it's going to be a lot more about what you know than who you know. And you're going to be able to train AI models on things like our own data sets, create predictive models, and to be able to invest into a wide swath of companies and drive really solid outsized returns in the venture asset class. So a lot of venture capitalists are talking about this. The dinosaurs are going to go away. And this is going to, what I would almost say is I think venture capital is going to look more like hedge funds do today, right? Very data driven, utilizing, special algorithmic models and, special data sets to identify that deal flow in a way that's never been done before. And that's going to drive some of the largest new funds that have ever been created in the next decade.
Okay. So yeah, like the venture quant fund, so they're like,
It's going to become way more quant driven.
Yeah. You want to get your Roth IRA in that one, like the people at Renaissance Technologies, by the way, for the hedge fund they have this Roth IRA program. It's pretty fascinating, actually. Self-directed IRAs investing in their own fund. That was like the number one perk to work there was have a Roth IRA or Roth 401k invest in their medallion fund, which was a quant hedge fund. But well, Chris, anything else? Places where people can learn more about this? Where would you send people? And Chris is going to be at our Alt Asset Summit, by the way, altassetsummit.com. I think I got you speaking on Friday, October 25th. So it'll be super exciting to get a little bit more details from Chris on that. You guys can meet him in person. Where can people learn more?
Absolutely. So if you want to learn more about kind of this entire ecosystem, we have a ton of educational assets and information. You could go to kingscrowd.com and check us out and learn more about what we got going on there. You'll also be able to learn more about the fund, kingscrowd.com/capital. And then if you want to reach out to me, I'm always happy to chat with folks trying to learn more about this space, or I'll send you to the right person on our team who could kind of help get you educated on this space. And that's just Chris@kingscrowd.com. But, if you believe at all that, the venture asset class and the alt asset classes is a part of what you want to make your portfolio look like and have a part of your portfolio, I highly, highly recommend do your homework, build a diversified portfolio, and make sure you work with the right partners along the way. But it really is an exciting time to be in this asset class.
Awesome. Well, thank you so much, Chris. Thanks for coming on, sharing your expertise and insights. Thanks for everyone for joining us. This will be posted at directira.com/webinar within a couple of days. So if you missed any part of that, the whole recording will be up there. And make sure you're subscribed, of course, to our newsletter, where you'll get updates and information on workshops, webinars, upcoming events, all the educational content we're trying to deliver to you to make you a better informed alternative asset investor. We'll see you next time.